Today, we explain what inflation is and why it is important. For policymakers, what is driving inflation and the likelihood of its persistence matters, and what policymakers do is an important driver of asset prices. Hi, I'm Peter Dragicevic, macro strategist at Evans & Partners. Inflation is an increase in the level of prices of the goods and services that households buy. It is measured as the rate of change of the price within the Consumer Price Index, which is a specific basket of goods and services weighted by the spending patterns in the economy. In addition to promoting full employment, central banks have a price stability mandate, which is aimed at controlling the rate of inflation. In Australia, the Reserve Bank targets 2 to 3% inflation on average over time. In the US, the Federal Reserve targets 2% per annum inflation. Over the medium term, price stability, or a relatively constant level of inflation, is a fundamental economic pillar that helps preserve the value of money and has led to relatively more stable growth as it gives businesses and consumers confidence to plan for the future. Typically, prices rise over time, but prices can also fall. This is called deflation and was the main risk central banks were grappling with in the period prior to COVID. However, we are now in a different environment, with inflation running at multi-decade highs. This has caught markets and central banks off guard. Given its importance, what is driving inflation and the likelihood of its persistence matters most for policymakers. That is why understanding the different types of inflation is so important. The main types of inflation are demand pull inflation. This occurs when activity is strong and demand for goods and services outpaces the ability of an economy to increase its capacity. Cost push inflation is the result of a jump in input prices working through the system. A large lift in oil or a one-off tax hike like the GST are examples. Policymakers usually look through and don't respond to these shocks because they're not expected to last. Built-in inflation, which is also known as the wage price spiral, occurs when the cost of living rises, and in response, if the labour market is tight, workers demand higher wages. To offset their higher costs, businesses then raise their prices, leading to a self-reinforcing inflation loop. There are elements of each of these different inflation types now at work. Since the onset of COVID, the mix of strong demand on the back of all this policy support that was provided and the rolling supply disruptions has seen goods inflation surge. Tight labour markets are also starting to feed into stronger wages, and inflation expectations are moving up. After keeping policy settings too loose for too long, global central banks are now reacting to the very high inflation by aggressively raising interest rates. Policymakers are trying to make up lost ground so the inflation problem doesn't become entrenched like it did in the 70s and 80s. Prolonged high inflation is problematic as it erodes consumers' purchasing power. This is particularly an issue for lower income households as high inflation is a regressive tax. High inflation also distorts spending and investment decisions, and it can lead to a self-fulfilling change in consumer and business price setting behaviours that can become embedded. The tightening in policy settings that is now underway is designed to slow down growth, rebalance demand and supply, and get inflation back down to target over time. Over the past few months, this abrupt shift in interest rate expectations has generated a lot of market volatility. The policy normalisation process is only partway through, and the economic impacts are yet to materialise. As such, volatility may continue for a while yet. The path forward for inflation will be critical for markets as we head over the rest of this year. To find out more, please contact your advisor.